Hey guys, welcome back to the program. Tim Knox here with you. Got my buddy back from California today, Michael Zuber, not Michael Gerber, Michael Zuber, the author of One Rental at a Time. He is my go-to expert on all things rental. And Michael, welcome back. How are you?
I'm doing great, Tim. Thank you for having me back. It's always fun.
Good. How are things in California?
Things are good. I think the weather's warming up. People are getting out and about a little bit. We're starting to open up the economy a little bit. So I think people are starting to feel a little bit better.
Are you still quarantined?
We are. I think we're in phase 2, I guess. So better than we were. Right? Felt like 100 days on lockdown.
Yeah. What I love about watching your videos is I never know what state you're going to be in. Some days you're clean shaven. Some days you got the beard going. It's just, it's like the 10 stages of hygiene at Michael's house.
Yeah, exactly. So here's the rule of thumb. Any day I show up clean shaven, that's because the wife bugged me the night before saying, "What the hell?"
Yeah, look at
that's
the
answer.
scroungy there. So, hey, give the folks a really quick thumbnail of who you are before we get started.
Yeah, so my name's Michael Zuber, author and publisher on YouTube of One Rental at a Time. Essentially, it's a passion of mine to help people understand and appreciate that rental properties bought conservatively, cash flow, not betting on appreciation, really can be a path to a better financial future. And if you stay in it long enough, financial freedom.
And I have to tell everyone, yours is my favorite book on the subject. I bought it. I read it. That's how we met. Book is selling well. How's the you did the audio version?
I did, yeah. The book sold so well on Amazon and Kindle. I'm a self-published guy, right? I got no publisher behind me. It's just me. But I had so many requests for Audible. We went ahead and spent several $1,000s getting that created, and it's almost sold 900 copies in about 8 weeks.
That's
so
amazing.
Beyond my wildest expectations.
Yeah, for a long time in my life, I was a publishing coach. And I worked with self-published authors, getting them packaged, getting put together. And 900, that's a pretty damn good number right there. I mean, considering that most self-published authors might sell 9, that's pretty good. But I think a lot of it has to do with the book itself, because it is, again, my favorite book on the topic. And that's what I want to talk about today, because it's been a little bit since you and I talked about what's going on in the rental market, what's going on around the country. You do a really excellent video cast every day where you talk about not only rentals, but financials and that sort of thing. So let's just kick it off. What are your thoughts about where we are now, and what is going to be the impact of everything that's happened over the last few months on rentals?
Yeah, I think the answer for most of the country, so we'll talk about both sides, because I think in what we're about to experience, there's a clear line of winners and losers. Mm-hmm. I think most of the country, geographically speaking, is the single family rental is going to be the best investment for the next 10 years, right? And I don't say that with any hyperbole. I don't sell anything, right? It means nothing for me to say that. I just think it's true. I think a single family home in Huntsville, for example, where you are, in Fresno, where I am, in most of the country is going to be the best thing. Because, why do I say that? I think there is fundamentally a shift in this crisis. Everybody remembers the last crisis. And this crisis clearly says space is good. And what that means is the verticalized cities of New York and San Francisco, which are the easiest examples, you have a whole set of people that were paying premiums to live there, right? The nightlife, the entertainment, being close to work, all of that. That now are like, man, space is good, right? I gotta, teach the home is now your office, your gym, your school, and just all of these things are tough to do, let alone confined to an elevator and all these other things that come with high-rise living. People are going to be living. I've been calling leaving. I've been calling it for several weeks now, if not more months. And now we're actually seeing the data. The suburban flight is real, right? And the single family homes are getting bid up. Invitation homes, 80,000 rental homes in 16 markets. The largest landlord was just on CNBC today talking about it's a good time to be a landlord in these markets. So again, I think if you're in most of the country, let's say ex New York and ex San Francisco, for example, you are going to want to own rental homes. You have inflation coming today. The beauty of residential is you can lock in 30-year money sub 4%. As an investor, if you're an owner, it's sub 3%, right? You are going to be printing money when inflation kicks in, even if they hold it to 2 or 2.5%. I don't see any better investment for the next decade than a single family rental home. It's awesome. Now the other side, the losers, New York and San Francisco, anything that's vertical, right? Maybe Seattle. You're going to have Class A apartments drop because they're, first off, those are the first things overbuilt. They're having tough times renewing leases. And there's a whole buyer pool called the millennials that were frequent occupants of these towers. Mm-hmm. Now they're in their 30s. Now they're having kids later in life than past generations. They're also going, space is good. And these are qualified buyers, right? They chose to rent as a fundamental decision. Now they're like, damn, I need to own something, right? So suburban flight is real. Those cities are going to lose. San Francisco, multifamily, New York down. Cap rates are going to go up. It's going to be a horrible time to own Class A in those markets. But again, most of us, right, the simple people like us, we just own rental homes. And, you know, if you're in suburbia and you're not overpaying like in San Francisco or New York, you're going to be doing pretty well, I think.
Yeah. So that's suburban flight. This is people moving out of those large cities into the suburbs. What is that going to do to the market in the suburbs, though? Is that going to drive prices up?
Absolutely. I mean, it's all supply demand equation. You know, the last couple of years we have underbuilt in those areas because for the longest time the millennials wanted to live in cities, right? That was what was done. So what did builders do? Well, they bought and they just built bigger. Now that is changed out of nowhere. There are projects that are midway through that likely won't finish because they're just the demand has gone away. But yeah, suburban prices are going to go up. And the beauty with both New York and San Francisco is their main employers, right? Finance in New York and tech in San Francisco. Mm-hmm. Most companies are saying working from home is okay.
Right.
Some of them are saying work from home is what you have to do. We're going to shrink our office space. Man, so if you're in New York and San Francisco, which are ridiculously high taxed states, eventually, right, you're first off, you're not going to believe your employer for the first 3 or 4 months. Like, yeah, you're kidding, right? That'll change. Mm-hmm. But, you know, we get to January or February and they're still saying live where you want. Watch out, Texas, Nevada, Florida, low tax states. You know, you can take a 5% whack in your pay and go to a state and save 12 or 13% by removing the state income tax. It's right. Going to become a big thing.
I think the work at home, it's not a phenomenon. It's been coming for a long time. This has just kind of pushed it. Oh, yeah. You know, I think that's also going to change the way people look at homes to buy.
Oh, for
homes
sure.
to rent, don't you think?
Oh, yeah. Again, space is good, right? If the home if the home has to be school, gym, office, family, you know, an extra bedroom is going to be good, right? Call it a den, call it whatever you want. Mm-hmm. An extra bedroom is going to be important, right? If you used to do 3 2s, people are going to be looking for 4 2s, right? They're going to be looking for 2.5 car garages, right? So they can turn that little cubby in the garage into an office. Just remember, space is good. I'm a simple person. This crisis has taught us space is good. Front yard, section off from the backyard. I mean, it's just space is good, and you're going to get values are go up, rents are going to go up, and being a landlord is going to be a good thing because my houses today, even in Fresno, California, houses are renting fast, like less than a day. Mm-hmm. Apartments, you know, especially if they're apartments, you know, kind of stacked and like 8 on the bottom, 8 on top, mm-hmm. They don't rent as fast. Yeah, and I've owned them for 20 years, so I got the data to prove it. It's just houses are where it's at today.
Yeah, that's what I was going to ask you. What is all this? What does it mean to the investor? If I am now out there looking to buy single family homes, what am I looking for? And what's it going to do to my math? Because chances are I'm going to have to be paying a little more than I would a year ago.
Yeah. So I teach every student the same thing. You need to go learn your market. Today in most markets, inventory has gone from really low in January to record lows in June. Yep. Right. It's like unnatural levels. So this is probably not a great time to buy as an investor if you you haven't researched the market. I believe every market from Fresno, California to Huntsville, Alabama has an average. So what I tell people to do is you need to stop being lazy and look at your market for 90 days in a row. Right. And you need to understand what average is. So I can only speak to Fresno. An average house below the median produces about a 6% yield today. So when you do the work, once you understand that average, your job is to do good or great deals, right? So you're going to want to get a 7 or an 8% yield. But so every market has an average. So that's the first thing you have to do. And then as investors, we don't have to say yes to everything. Even in Huntsville, there's hundreds of listings. Most of them from an investor standpoint are bad, meaning alligators, or average. You just got to find a way to create the extra. And at least where I am today, one of the best things to do is to buy a 2-bedroom, 1-bath, 1,200 square feet, and then create the third bedroom, right? Buy it as a 2, right? And make it a 3. There's actually one I bought that's a 3-1. It was 1,800 square feet. I am making it a 4, 1.5. Right. So because buy it as a 3, rent it as a 4, the rent goes up almost $250. So you just got to know your numbers.
And I think they have to be flexible on those numbers. Because you and I both know, we know these investors that, these are my numbers. I'm not going to change. It's in concrete. I kind of think that's gone, because if you do maintain that hard-headed attitude, your deal flow is going to be a lot less.
Well, this is the deal, right? In a market like we are today, that investor shouldn't even waste their time, right?
Yeah.
I share my weekly updates with my audience, like what I'm doing. Like 5 weeks ago, I was writing 10 to 15 offers a week, right out of the MLS. And it's because I was expecting listings to explode and demand to come down. Fast forward 5 weeks, I was freaking wrong. Right. Supply went down.
No way.
Yeah, I was wrong. Supply went down and demand went up. So I'm not even wasting my time anymore. Right. I have to rely on off-market opportunities today. Will that always be the way? I don't know. But there are just sometimes investors, if you're buying for cash flow and looking for good or great deals, it's not the time. And just like 06, we might be in that little window, because if supply is so small, you don't want to overpay. The last thing you want to do is feel like there's no opportunity, overpay by 40 grand and have an alligator. That's the last thing you want to do.
Yeah.
Right? Sit on your cash, wait.
Yeah. Kind of as a sideline here, talk a little bit about your formula. Before this, when you were making 10 offers a week out of the MLS, what were you looking at numbers wise? What were you trying to buy them at? What was your margins, and how has that changed?
Yeah. So what I would always do, so let's talk about, so I use yield as my calculator. So let's talk about what makes that up. So it's 2 numbers. The denominator is easiest for people to understand. So that's just all my cash to purchase the asset and to make it rent ready. So it's really 3 numbers: down payment, closing costs, and then what, if any, make ready I have to do. Right? Am I buying a junker where I have to spend 20 grand, or am I buying turnkey that number is 0, right? So those 3 numbers make the denominator. Then the numerator is my expected yearly cash flow. So it's rent or lease minus all expenses, including fully burdened mortgage payment. That produces a number, times that by 12, which monthly becomes yearly. And what I want that number to be in my market today is greater than 7%.
Okay.
So that's my math. I have a spreadsheet. It's very simple. It's like 12 columns where that's my answer. I don't give a rat's ass what a property is listed for. I do my math and say, in order to get a 7% or greater, I got to offer X. And 5 weeks ago, I was making lots of offers to make X. And I was getting basically told to F off because I was wrong. The listings didn't grow and demand shot up. So that's what I always look for. And the beauty of this is, that changes. If you were to ask me what that yield number was in 2010, it was 15%.
Oh, wow.
Right? It just changes. The other thing I've done is I just did a video recently focused on the first house I ever bought on Norris Drive. When I bought it for 107, the yield was 11%, I believe. When I sold it at 264, it was negative 10%.
Wow.
Right? Alligator, right? So that's what I mean by investors be careful, right? Because you can overpay and have an alligator. Then it forecloses and it sells for 75. The yield's 21%. And then you come back today, it just retraded and it's like a 4%. So again, learn your market, understand what averages, only do good or great deals. It's hard for people to get that. They just want to be active. They want to do it. And that's like walking into a casino walking up to the roulette wheel and say, hey, I'm going to bet 23.
Yeah. Well, it's like, you know, you and I had this conversation earlier that there, just as an example, there was a house here in this market, that little house, decent neighborhood. Someone had bought it, had done the demo, and then went, what the hell am I thinking?
Yeah.
And decided to just list it on the MLS with a realtor. Well, they had it listed almost at retail. And I'm like, and I walked this house and I'm like, this is an easy 20 grand to finish.
Yeah.
Where is my mark? And I told the realtor this, and she's like, hey brother, you're preaching to the choir, but guess what? He got multiple offers at that price. And there's just no way an investor is going to walk in there, spend that money, and this is something I hear, well, I'll just ask more. You know, if I have to invest more, I'll just ask more. And so whoever ended up buying this house is either going to sit on it for a long time, or they're going to lose money because they are immediately upside down.
Yeah. And again, I stay engaged in my market. I still look at my market every day, and I've been doing it for 20 years. So to think you can walk into any market and learn it in a weekend is insulting to anybody who's been doing it.
Right.
But you know what? If you want to make stupid offers and lose money, that's free market. By all means, go nuts. I am not going to make a stupid offer, right?
Yeah.
I am not going to be chased into overbidding. Now, some of you could say, I'm lucky, I already have my portfolio, blah, blah, blah. But I have felt this way since day one. That's why I wrote about in the book, One Rental at a Time, there were 2 periods we stopped making offers. Once happened to be after we did all the 1031 exchanges into apartments because the market was just red hot and stupid. And the other time was when, coming out of 2010, when the hedge funds came in and started buying everything sight unseen, right? Because we saw a change right away out of the MLS or multiple listing service, right? We were buying deals seemingly every month, and suddenly nothing was there. It's like, what happened? So you got to watch your market, learn what averages. People don't get it. And I have a course that helps them get it, and they don't understand. All you have to do is watch your market. It tells you what's going on. And if you don't learn your market, you're going to make a bad deal.
Yeah. I did a video the other day about how the number one killer of most real estate deals is emotion.
Yes.
You know, the emotion of the buyer or seller. And I'm seeing that a lot in the investment community. It's almost like there's a fear of missing out.
FOMO. Absolutely.
FOMO. And they're coming in willing to overspend and buy, you know, losers from the word go because they don't want to miss out. You seeing that?
Oh, I see that. I see that every day, and I preach against it. I try to help people realize that sometimes no deal is better than a deal, right? A transaction, a loser transaction is a loser transaction. And I mean, I can only go back to my personal experience, right? That first house I bought for 107, 3 years later, because of FOMO, that house was bid up to 264. The rent didn't change. The rent didn't change. It went from a positive 11% yield to negative 10%. It doesn't matter. It was never going to cash flow. So the only answer was you were going to lose that house eventually. And unfortunately, that owner lost it 3 years later. And it hurts. Don't overpay. Fear of missing out. And again, like we talk about, I believe this is a very unusual market across most of the country. Most of the country has unbelievably low inventory today, like Fresno, like Huntsville. But there are reverses. Las Vegas, San Francisco, and New York are exploding in listings because people are leaving. Right? It's a very unusual market today, and unusual markets are dangerous. Real estate is usually you can see it, but today it's dangerous. So be careful, learn your market is my strong advice.
Yeah. What are the opportunities and the pitfalls that people in those areas like Vegas, if I'm an investor there and there's lots of inventory, what are some of the things I need to be aware of?
Well, if you're an owner in Vegas, let's say you bought before February, right? Whether it's January or years before, your number one job right now is to make sure you can lease your properties, right? So some of you are going to have to take haircuts. It's just the reality, right? There's an oversupply. I talk to a broker in Vegas once a month, Brian Lebo, and their unemployment rate's north of 30%.
Wow.
That's not good.
Yeah.
That's not good. Now, a lot of them are doing okay because of the federal bonus of $600. So they're surviving. But if that ends in July 31st, be careful. So if I was an investor or owner in Vegas today, I would be doing everything I could to lock in the best tenant I could. I would slash rent immediately looking for that person. I would probably try to get prepaid rent for the rest of the year if I could. And I would do whatever I could to survive to the end of the year. So that's if you own. If you're looking to invest in Vegas, start learning your market and realize that Vegas has two markets, right? There's the housing market kind of off the strip, right? Which is like most of the country, right? Most of Vegas is not the strip,
right?
So there's that market, but there's also people that think you can Airbnb on the strip, right? Which had been outlawed by a lot, but I bet comes back. So first figure out what market you want. And I think that all those condo towers, be expecting 50% off sales sometime next year.
Yeah.
So get ready. And oh, by the way, you probably won't be able to get a loan. So you'll probably have to go cash because the lending standards will be so different.
Talk a little bit about that. What are you seeing happening? The lenders here are really tightening up.
Oh, lenders across the country are tightening up. And unfortunately, based on the stress tests that happened yesterday, right? Talking about the daily financial news that I do, that's game changer. I talked about it this morning. The stress test, which is the biggest financial institution, something they go through yearly, did not result in a happy, smiley face from the Fed or Treasury. So that's a problem. That means there's lots of bad debt in there. Now, they do a good job of hiding who the problem child are because they don't want bank runs. But the financial system is not as strong as they would like. And you know that because for the first time in over 10 years, they're going to audit them again this year. It was a yearly exercise until now. Second, they have frozen dividends and they're stopping stock buybacks. That just means they have to increase their capital reserves. And that means that like Chase and like Wells Fargo, who have already publicly come out and raised credit standards, they have retrenched from the jumbo market, which is a big deal for the Silicon Valley, right? Coming out of the jumbo market. Lending is going to get harder. Really, the only lender today is FHA-backed loans because the Fed is saying we will buy all we can. That's why you're seeing two markets in most areas. And it'd be interesting to see about Huntsville. If you are in the jumbo market, that inventory is actually growing. If you're below jumbo, flying off the shelf. So at least in the markets that I watch closely, we are seeing two different markets. If you have a jumbo house in Fresno, good luck not moving. If you're below jumbo, it's going to fly off the shelf in a day.
Yeah. One of the things that's happening here is we have a really huge influx of people moving here for work. They're coming from places like, and we talked about this, like DC, Virginia. They had a 1,500 square foot house that they sold up there and they've got $1 million.
Yeah.
And they come here to Huntsville, and with $1 million, you can buy a lot of house. What is your advice to those folks who are in that situation, looking to do a 1031, invest that money wisely to keep Uncle Sam's fingers off of it?
Yeah. So if you're going to do a 1031 exchange, you have to do what's called like for like, right? So like kind for like kind. So you're not going to be able to do that with your owner occupied house. That's a big no-no, right? So it has to be in a rental. But I know there's investors in Southern California that I talked to yesterday. They're selling a house in Orange County, right? That they inherited decades ago from their parents. So the cost basis is whatever, nothing. But they're going to pocket about $1 million, and they're doing a 1031 exchange into another state. They're getting 12 homes.
Wow.
Free and clear. Right, they're getting 12 homes, and their cash flow is going to explode. So there are good reasons if you're in a high price market to use this low inventory to sell and do a 1031 exchange. You got to go for like kind, so investment for investment. You have to go bigger. So this family is adding some cash to it so they can go bigger. But it could be a good time to get out of unfriendly states like California into more friendly states that are across the country. It's a wise tax move.
Are you investing outside of California now?
Nope, I am not. I'm not personally still in Fresno.
Fresno
is it's the 5th largest city in California. It has the price points are nothing like SoCal in the Bay Area, right? All the houses I own are sub 200K, right? And they rent for $1,250 to $1,500. So I'm comfortable there.
Yeah.
Will I always be? I don't know, right? One of the things, again, I've experienced this movie before, low inventory, rocketing prices. Let's play the movie out for people, right? I bought a house for 107, sold it 3 years later for 260. So I own houses today, let's just call it easy math, for 200 that rent for 1,500. If those houses, because of low supply, go from 200 to 400, I'll sell all of them. All of them. I'll be out. But at 200, they still make sense. They're still a good investment. I still own 6 or 7% yield. It's all good. But yeah, if we get into another hyper appreciation cycle, which happens in California, and we go from 200 to 400, I will gladly do what I did in 06 and do a 1031 exchange out of houses into apartments.
Well, what you can do is you can take all that money, come here, and buy half the city.
It would be several $1 million for sure.
You could do real well. Hey, buddy, this is always fun. You are my expert. If folks want to learn more about you, about the book, where do they go?
Now, the best way to follow me is to check me out on YouTube. It's called One Rental at a Time. I put out original content every day, over 4 hours of original content every week. And if you want to learn the story of One Rental at a Time, go to Amazon or Audible. The only thing I ask is after you buy it, you got to do a review. I'm a self-published guy, so those 5-star reviews really help.
They do. And I highly recommend this book. Like I said, I actually bought and read your book before I bought my first rental.
Nice.
And I still have it. It's
nice.
Doing quite well. So, hey, buddy, this is always fun. Let's do it again anytime.
You got it.
All right,
you got it, brother.
Have a good
Take
one.
care.
Be safe.
Bye.